Hello and welcome to another edition of the Fervent 4. Did you know that only 4% of businesses ever cross the annual $1 million revenue mark? Hello, I'm Zack Miller. I'm still Zack Miller. Yes, after all these weeks, I'm still Zack Miller. Sorry, folks. Author of Anomaly. With me today, my co-host, Tim Ryan. And he's also still Tim Ryan, sometimes known as Ryan Tim, but today he'll be Tim Ryan, lead man at StartWheel.org. Thank you so much for joining us. The Fervent 4 is a weekly show each and every Thursday at 11 a.m. dedicated to sharing insights into growing a world-class business no matter the climate. Something that we've never done on the show before that we're going to start today's off. These guys don't even know that it's going to happen. We're going to have them give their quote-unquote elevator pitch. They have no idea that this is expecting. That I could see there's so much animosity towards me right now. They're like, can't believe this guy's doing this. I met them like literally 13 seconds ago, and they're like, who is this guy? I cannot believe it. But guys, let's hear it. What is the Pocket Properties pitch?
So $228 trillion. That is the current value of the global real estate market. In fact, real estate is the third largest industry in the world. It's also the third fastest growing industry in the world, followed only behind healthcare and higher education. The problem is very few people can actually participate in and take advantage of the growth and potential that real estate has to offer. Meet John. John is 30 years old and he's always wanted to start his real estate portfolio. He's really hungry to get into this incredibly lucrative and proven market. However, under the current landscape, the average millennial real estate investor's net worth is $1.4 million. To put it simply, you need to be in the top 10% in terms of wealth to participate in the real estate markets. Until now, my name is Chris Rumper, and that's Stanley Glover. We're the co-founders of Pocket Properties. Pocket Properties is a mobile-focused platform that allows users to buy, sell, and trade fractional shares of real estate for less than $10.
Now John can realize his dreams of starting this real estate portfolio. He simply downloads the Pocket Properties app, sets up his profile, and within minutes, he's able to browse our available properties. Once John sees a property that he's interested in, he uploads funds and in a click of a button is able to purchase his first share. John is just one of over 90 million people in our target market. Investors like John have been buying and trading fractional shares of their favorite stocks for years now. The introduction and acceptance of fractional shares has really changed the investing world as we know it. And fractional real estate is just the next step.
Now, in 3 months, we launched a trial marketing campaign to test the waters. And in that time, we've grown our launch wait list to over 1,000 members. And that list is expected to grow to over 10,000 by our app's launch in December. We're also excited to announce that we have over $500,000 in residential property commitments to prove our minimum viable product, with the team and network in place to easily end the year with over $20 million in residential property commitments. This will create an unheard of amount of variety in the fractional real estate space for our users. Now, Pocket Properties generates revenue primarily through the tokenization of real estate assets sold on our platform, but also through transaction fees generated from user trades, much like a standard brokerage service.
Pocket Properties is the first platform to compete in all the areas of the fractional real estate spaces by allowing for non-accredited investors, faster payouts, and a wide variety of investments. Currently, each of our competitors focuses in one specific area, offering extremely limited services on their platform. For example, Fundrise allows for non-accredited investors, but has a slow payout method, high entry costs, and is comparable to your basic e-REIT. Ground Floor, which is another one of our competitors, does not allow for unaccredited investors and is a crowd-funded short-term loan site with very few developmental loans. Realty is our closest competitor, focusing on the single-family residential space in low appreciation areas. This company has proven to be slow to expand and has displayed poor communication techniques with its clients and also has a highly limited inventory of properties on their platform.
Our team will build Pocket Properties into a household name. So co-founder Stanley Glover and I, we've been working together since 2016, starting 2 companies that have succeeded through sheer hard work and perseverance, and one that just didn't make it. Our CTO, Craig Paris, he's worked on product development teams for both Microsoft and Salesforce.
We understand the wisdom that comes with the experience. This is why we've established a seasoned group of advisors to lead us along the way and avoid any potential obstacles. Moving forward, we'll be releasing our app in December. We're also preparing ourselves for seed funding in the near future with the goal to raise just over $500,000. This is to ensure that we have the proper regulatory and product development foundations.
Now, with your help, we will accelerate the pace at which Pocket Properties becomes the industry leader in fractional real estate trading. Then our customers and supporters can join the growing class of millionaires. With that said, I would, this is typically where we'd ask if you have any questions. Obviously, we'll pass the questions over to Tim and Zach.
Questions for you. All right, let's. That was a good pitch. Honestly, it was good. There was good enthusiasm. So it's definitely tailored and catered towards a very specific audience that might not know a lot of keywords. I want like the first thing that I'm thinking of, and when Tim was explaining this to me a couple of days ago, I thought of like a stash or Robinhood or something like that for real estate. I think historically people have looked at investing in a business as either the stock market or you have to be an accredited investor. Accredited investor, someone who I think at this time is worth like 300 grand or something like that. So, $1 million in net worth.
It's about 200,000 if you're a single
individual, 300 as married.
Yes, and then $1 million worth of asset that's not including your home.
So but real estate isn't the same as that, right? So like to buy a house, you don't have to be an accredited investor. You just have to go through, a ridiculous amount of paperwork. So you guys said accredited investor though in that. Why couldn't anyone just invest in real estate? Because it's too much money and because you can buy it from a fractional standpoint, like a stash? Is that the big play here?
Yes, sir. Chris, did you want to elaborate?
So essentially, I mean, what we're doing is taking it and we're making it significantly more affordable. So, I mean, when we look, what we're thinking of our more direct competitors would be a Fundrise or something where there's going to be a higher cost to entry. What we're trying to do is really eliminate that cost as a barrier of entry. We're trying to give people the freedom to fail in real estate investing. To be frank with you, that was kind of a lot of the mentality that at least kind of inspired me when Stan came to me with the Pocket Properties idea. It's just because with real estate, like you said, there's leaps and bounds that you have to go through in order to actually buy a property. Typically you're going to have anywhere between $3,000 to $10,000. That is not much freedom to fail. You're going to have to take out a loan. Whereas with a stock, very minimal investment. I can lose $5. I can lose $10, and I can gain a wealth of experience and knowledge along the way. So that was kind of our thinking with that. If that kind of helped answer the question a little bit.
Yeah, I mean, it's just instead of having to put down 10% on a couple $1,000 house just to get a mortgage, and then you're responsible for that mortgage, you can just purchase however many shares you want, and then you can diversify amongst multiple properties as opposed to putting all your eggs in one basket.
Exactly. And you can also diversify. You can tailor your returns as well too. So you're not stuck to a fund that's giving you a set percentage. I can invest in this property, which is yielding this much return. I can invest in this property, which is yielding this much return. So it's a lot more control as well too.
Yeah. How long have you guys been working on this business?
So I want to say it was the idea first hit paper in early August. We really started.
I'm good. Okay.
So
like 7 years. Don't ever say
okay. No. So we came up with the idea back in early August. Really September was kind of the Chris and I, we wholesaled together for about 1.5 years, which for those of you who don't know, is kind of middlemaning real estate investing contracts. So we were doing that full time before this, and back in around September, we decided, hey, let's put all of our focus on a Pocket Properties. We think we have something that could help help a lot of people and create a new industry.
Yeah, and then we delved. I would say we full stopped in January. Like our first post on the Pocket Properties Instagram page, I believe it was like January 7th, was when we just, full stopped wholesaling. And at that point, it kind of made sense just based on the amount of traction that we were getting from our friends and family, from our direct marketing campaign. Because I mean, I've started and failed businesses before, so when you see the type of traction that you get from your friends and family, like at this point, they're harsh judges and very real judges of my business, which is good. I want that.
Really, that's interesting. So I found the exact opposite, right? So like I find that, like, I call it the mom effect, where your friends and family are always going to be like way too positive, and they're a terrible indicator. So it's interesting that you have taken this and said that they were a good indicator of moving forward in something. Like, I almost think that you should never get friends and family to buy, or at least make a huge decision off of, because they're so tied to you that they want to see you succeed, which is great. Take all their money. I'm not saying that, but I think from a business perspective, a lot of times they can provide you really misleading data points. And it's interesting that you've taken the opposite effect, and it seems to be in a positive swing.
Which is typically, you're exactly right. The reason why I say they're good and harsh judges now is because I've failed. They've watched me fail publicly with multiple businesses before. So at this, it's a thing as a young entrepreneur. When you start businesses, you fail, you start and you fail. So with the first one, I felt all the fake support in the world. With the second one, you see it kind of dwindle. And then with by the end of it, you're realizing when I come to people, they're going to give me their real reaction now. So at this point, seeing the traction that we were able to build with our friends and family, it was not typical. Also, just the follow-up questions and stuff like that. But no, you're exactly right. Traditionally, friends and family, horrible judges.
What you learn most from? Did you ever learn more from your wins or more from your losses?
More from, I'll say both. It's kind of a political answer, but I'll say I definitely would say both. When you fail, you learn a lesson, and you learn it very quickly. Do you know when you're failing? Not all the time. Mm-hmm. Not all the time. Sometimes it has to blow up in your face for you to realize, hey, this was not a good idea. And once again, Chris and I, we've started 3 businesses together. And one of them was one of those situations where it blew up in our face, and we were like, that was a dumb idea. So
what was it? Was it the wholesale stuff?
So we did a digital distribution and artist management company. So essentially we managed hip hop artists out of Richmond. So, first off, artists don't want to pay money. And second is Richmond. It's not Atlanta.
It's not Atlanta. It's not LA. It's not Miami. We do not have there's not a very popping club or music scene here to push the music as well. So we kind of realized it was not necessarily the place for this industry. And then also the amount of time and energy that it's not necessarily worth it.
Interesting. So not to touch on that a lot, but I think it could be really, really important. So you realize that the market that you were in from that old business was the wrong market, and it just didn't work. How do you recognize, not necessarily that was the case back then, but like with this new business, that the market that you're in now, or the markets that you're trying to explore and get in, are the right market to actually see this thing hit? Because it sounds like if you were doing that business in Atlanta, LA, maybe even a Nashville type of thing, music centric areas, they could work. But right. How do you know that? I mean, to me, Richmond, Virginia, right? The 757, 804, those are not areas that I think of as real estate central. How do you know that this is going to work from a just operational standpoint, and not do it in a big city where there could be a lot more opportunities?
Well, to be honest with you, where we're exploring investment options, we're not necessarily our initial investment options aren't necessarily going to be in Virginia. However, when it came to actually kind of recognizing that this was something that was, recognizing that this is a business that, the market is there for it. I mean, it's all kind of, it's traction based in the fact of, you know, we're looking at our competitors in the market. We're looking at just, you know, if you look at NFTs, the way decentralized finance is going, period, real estate is really the next industry that's primed for kind of massive disruption. But we aren't, and to kind of hone back in, we're not necessarily focused on just investing in Virginia or Richmond or like, you know, 757 area. Our initial acquisition strategy is that so that we can actually tokenize properties pretty much anywhere. Granted, we are looking to keep them in a concentrated area, just because it's going to give us as a company the best return on the back end, because we'll have the most control over the property values in a concentrated area. But you know, we're not going to tie ourselves to a you know, kind of a secondary city. But even so, secondary cities like Nashville and Richmond are growing nowadays. So.
Yeah, and talking about timing, Zach, you know, he touched on the market, and then the other thing that has really come to help you guys is the fact that the SEC has changed their rules. So now you can solicit and you can raise money by talking to the public about this, and people that can also, the other big aspect is the fact that you can now accept investment from non-accredited investors. So can you touch on that in terms of you're trying to raise money? You know, what are you trying to do, and what methods are you using?
Gotcha. So the like Tim said, the regulatory landscape has really shifted in the favor of, you know, the common person. Still got a long way to go, but the SEC did release back in, I want to say 2019, they called it Title III regulations, which are so Regulation CF, which stands for crowdfunding, Regulation A+, which allows for you to distribute securities to non-accredited investors, and it doesn't necessarily have a cap limit on it. I believe the cap is like $17 or $20 million a year, something like that. Some down in the weeds.
But either way, it's really it's allowed us, to be honest. It's kind of a beautiful thing, just because, I mean, especially as a you know, we're a Black-owned company. With Regulation CF, it allows us to kind of take the raise into our own hands. So right now we do have our WeFunder campaign that's up. So like, if, you know, for anyone who's a non-accredited investor, if they're interested in investing in Pocket Properties, they could go to our WeFunder campaign, you know, learn some more information and decide, you know, if they want to invest for as little as $100 through that platform. Whereas traditionally, you know, with these SEC regulations, that was not something that was available to non-accredited investors. It was just not a thing. It made raising a lot more difficult.
So it's still confusing. So where is the issue with the accredited investor in a house? Is it because there's multiple people investing in this property, and that's where the accredited investor had to come in, and now they don't have to?
Right. So the traditional issue with, I mean, it's more a lot of bureaucracy.
Sure.
That's really what it came down to, is they would consider, you know, non-accredited, someone who makes less than $200,000, unsophisticated person, and therefore are high risk, and, you know, shouldn't be afforded the ability to invest. So it's a lot of bureaucracy when it comes to that accredited investor screening, simply for the fact that, you know, there's loopholes around it if you really want to try to get around it, you know, as a non-accredited investor. So it's just, you know, it's just one of those barriers that's used to keep, you know, the commoners out.
Interesting. So who hates you in this world? Not like personally, but who is going to hate this idea, type of thing, right? So
we're anticipating we're going to get a lot of pushback from you know, the standard real estate investor. Mm-hmm. A lot of pushback from REITs, because that rich person now is competing against 1,000. Exactly. So if you look at how Robinhood has you know, the whole retail trader debacle that they had, where everybody was all on, you know, all the stock channels all
GameStop.
Is that the Reddit thing?
Yeah, about the Reddit thing, because, you know, some kids were coming in and messing up the institution a little bit. You know, we're anticipating a very similar thing. You know,
just because it's not
some of the giants in the industry. I mean, you know, there's a lot of people who own properties who run REITs. You know, you got Blackstone, Redwood Trust, some of those really massive companies that, you know, aren't necessarily putting out a great product.
Mm-hmm. Yeah, I mean, it's interesting to think.
But
you get a pool,
for lack of a better word,
you get a pool of people together, and they all want to invest. And next thing you know, you have a group of your closest friends buying city blocks, and you know, who knows what you're going to turn the neighborhood into. I say that jokingly. However, I think that that's one of the long-term benefits that you all have in terms of urban revitalization. You have an area that needs to be revitalized, and then that's a great investment opportunity for thousands of people as opposed to the one or two developers, how it's been done in years past.
Exactly. And to kind of piggyback off what Zach was saying, we are expecting pushback from those from the larger, more institutional investors. But I mean, down the road, to be honest with you, I think what it's going to do, though, I mean, more inclusion in the markets. All it leads to is more appreciation on the actual assets and commodities. If we look at, I mean, since Robinhood, since the development of Robinhood, I mean, all that's done is been good for stock prices. So, I mean, you know, the older investors can complain as much as they want to. The institutional investors, because I'm more of a traditional investor myself. I Stan's the crypto guy, but the proof is going to be in the pudding. And you can't necessarily deny this kind of tidal wave that's coming of decentralization.
Is there a crypto avenue of it? Is there a crypto piece to this?
So we do have a blockchain piece. Now, the reason that we do that is we're big fans of the smart contract abilities of a lot of these chains. So there is a blockchain component that does run the back end.
But it's not like an engine that's running off of some sort of.
You're not mining anything. You're just keeping a ledger of the property transactions.
Yeah,
which is the best piece about a blockchain piece.
Exactly,
right.
and that's one thing. You know, a lot of people have complained, and you know, we've all seen it of companies that are not transparent, especially with this Robinhood thing coming up.
I mean, that's a big thing. I mean, like right now, I mean, just the whole short selling of stocks, to me, I think is un-American, and why you would want to bet on a company to fail.
Right.
You know, whereas if you know, but with you guys keeping a ledger of all the property transactions, now, you know, that's permanent record. Whereas, and it's full transparency. So I think it's a great thing for the real estate side.
So something from a risk perspective, you know, someone owns a house, then they're, you know, from an individual standpoint, they have to keep it up to date and things like that. When you have 100, 1,000, even maybe 20 owners of that, how does that go down? I'm sure I would think that would be a lot of people's pushback is like, how do you keep the house up to date, up to code, you know, so that it's not, you know, so the lawn's mowed and stuff like that.
Yeah.
No, and you're exactly right. That was one of our biggest concerns as well too. I mean, in managing multiple properties and being essentially, we want to be the stock market for real estate. But at the end of the day, we don't want the properties that are listed on our platform to be, you know, slumlord property. Like, we are not going to be slumlords. We want to make sure that the properties that we're developing, that we're investing in, that we're providing, that this is quality housing. So we are going to have, we plan on outsourcing our property management. In the early days, we're going to handle a lot of it ourselves. And then we are going to put together an in-house review board just to, you know, essentially handle resident relations.
So that you don't have a slumlord-like property? Is that what you're saying? Like, so you have a review board?
We are going to have an internal, essentially, review board for like resident relations, just to make sure that our property managers are keeping our properties up to code, because we've built in.
So you have your own like home management credit score like system to make sure that that thing has it meets the criteria that you want it to, so that you don't get into that kind of situation.
Correct. Essentially, our plan right now, as of right now, is to have essentially it's going to be quarterly reviews of our properties. Mm-hmm. So essentially, whether you're going to have somebody physically at the property at least 2 to 3 times a year, just to review the property, make sure everything's, you know, just up to date, good to go. but also we are going to have people that, on a quarterly basis, sending emails, reaching out to the residents just to make sure that everything is working, that they don't need any upkeep, because it's something that we've built into our company's budget. So management is something that we've already, we put a lot of cushion in there for. So
So how does that work then? How does that work? So you have a property under management or administration, whatever you want to call it, and the HVAC system goes out. So you guys have funding built in the budget to take on emergency repairs, or a water heater breaks and then you have to, that causes a ton of damage. Walk us through that.
Yeah, so we actually have essentially 40% of the rental returns, and this is already included. So our on the user-facing end, we've already deducted this. So that when we say users are going to get a return of 3.5 to 12% annually, that's already, we've already calculated out that 40% that we're putting towards the maintenance budget of the property. So that's something that we've got ready to go at a moment's notice. Are funds ready to deploy for the maintenance of properties?
What I guess what your background? What how did you said the idea? It developed. So I want to hear more about that in terms of your backstory. To go from the music industry to property. What sparked that?
So full disclosure, essentially, we went from music. I went from essentially managing music artists in Richmond, Virginia, and handling digital distribution of music. And then from there, like Stan said, we realized Richmond was not necessarily the place for it. We got our main artist connected with a label down in Atlanta. He moved down there and he's had great success since, which is great. But so we took a few months off. We're kind of looking at things that were going to be more guaranteed. What's tried and true, what's proven, that we can take our skills that we learned, prior to music. We were in sales and sales management, doing door-to-door sales, managing sales teams. So we wanted to figure out what can we take our sales experience and knowledge there and directly apply to something that is tried and true, that we can make money. And that was real estate. And it took a little while to learn and figure out what method we were going to use. We fooled around. I think it was like syndication at first, and then there were a few other things that we were trying to do. And then we finally realized, all right, wholesaling is probably just going to be the straightforward, the easiest, and something that we can directly apply skills that we have, and really something that we already know, a sales system, like a direct sales system that we can use, and we can take that direct sales system and use it over here. So that's what we were looking to do when we went from music to real estate. It sounds kind of random, but it's less. It was a bit more calculated, I think, than it seems.
That's really where I'm going, in the sense of so many people today, they limit themselves as to where they can go because they're not an expert in this, or they can't start a business because they don't know how to code. Whereas you guys just like, hey, this is an opportunity. Let's go after it and let's seize the opportunity. Absolutely.
And don't get us wrong. We had a lot of, especially starting out wholesaling. We did, there's a couple different methods to it. We did cold calls. So you know how that'll get in your head sometimes. You'll get cussed out on occasion.
That'll get in your head, Stan. That'll get in your head. Get out of here.
But
one thing that I'm sorry to interrupt, Stan. I love the hustle in you guys, in the sense that you don't let anything stop you. So share with us. You have a crazy goal that you had shared with me a few days ago when we were talking, about practicing your pitch and getting in front of as many people as you can. Share with us what your goal is with that, because I think that's something that everybody should aspire to achieve.
Yeah, so we're looking to pitch 500 investors in the next 60 days. And just because essentially with that goal, it's an unreal, we know it's a very high goal. We shoot for the moon, you land on a star. We understand that concept. So we push ourselves. But essentially the reason is we're going to get feedback. We're going to get a whole lot of rejection and a whole lot of no's. But I mean, we have a saying, right? Some will say yes, some won't say yes. So what next? It doesn't really matter what they do say. It doesn't matter what they don't say. You can never say the wrong thing to the right person.
And you're not even necessarily looking for money. You just want to talk to 500 people just to get feedback.
Mm-hmm.
Exactly.
People are gonna, if you're talking to 500 investors, if you're talking to 500 investors, those are also potentially 500 customers,
right,
of something like this that might be interested in something like that. You know, maybe these 500 investors. See, that's something like, I feel like a lot of people talk about customer discovery and that stuff, and they don't really understand and take it serious and really deep into it and really analyze what these people are saying. And like, I just feel like they're often like, oh, would you use this? Oh, do you hate this? It's like, you know, that's not really a great question to ask. You really got to deep in. So it is interesting that, 560 days. I mean, if you talk to a big enough group, I mean, that seems like it would be definitely feasible.
Yeah. And the reason I know that is because these guys sent me a list of they went through my LinkedIn profile and sent me a list of 120 something people that they want to be introduced to. And again, that's a credit to you guys. Wow. Something I offer everybody that I talk to, and you guys are the first people to take me up on that offer. So
he's not going to say that anymore if he's got a copy and paste on
120 emails.
Man. But yeah, no, that's one of our big themes. It's kind of, just not necessarily being afraid to put up those shots, and understanding that, I think we asked a question earlier about failure. It sounds bad, but you want to sprint towards failure. Being a young person, my goal is I want to have the failures of an 80-year-old man by the time I'm 40. Because if I am, I'm going to be very smart. I'm gonna be in a very good place. So that's
how old are you guys?
Chris, you gotta tell them how old you are.
Thanks, Stan. Throw me under the bus. I'm 26. I'm 26.
I'm 22.
Oh, well, I mean, you said 40, so I just wanted to make sure you weren't like 39. You never know. It seems like let's pair this with a stash or Robinhood, something where it's more awareness based, where it seems like the platform is there. It seems like this type of business from an operational standpoint is done in the past somewhere, and people have bought property somewhere, right? You're just skinning it a little bit differently and making it an opportunity for other people. It seems to me that something like a stash or Robinhood is really just to market the absolute crap out of this thing and hope that a lot of people will sign up. Is that where you guys think this is going to take, where all of the dollars that you're raising are really going towards marketing, or is there something that I'm missing in this kind of land grab play? No.
So essentially the money that we're going to be raising, to be frank with you, we've actually set it up we don't want to spend money on marketing. So we've got some really great guerrilla marketing strategies that include doing a lot of awesome shows like this one, in order to actually spread the word about Pocket Properties. And that's kind of going to be the strategy that we're using to gain our initial 50,000 to 100,000 users. We don't plan on putting, throwing an incredible amount at marketing to get people to sign up. Where we're making our money is going to be in the tokenization of the actual real estate. And then we're going to also be making money from the transaction fees and things like that. Our goal is just to provide the best platform for fractional real estate trading, because it's a new market. So there's really essentially we just want to be the Facebook of this market. We want to be Norfolk Southern. We want to be one of the largest. We want to be the biggest player in this industry, and we want to provide the best trading platform for people. So along the way, is that going to cause us to get a lot of people to sign up? Yes. Are we going to spend a lot on marketing? I don't think so. We're going to make a really great platform. And then we're going to show people that really great platform.
So why do you think a company like a Robinhood, a Stash, et cetera, have to pay so much money and not have some sort of guerrilla marketing that works? What's going to make you guys different in that kind of case? I respect the answer from before, but I mean, these bigger companies that just raise so much money, is it just because they have money to spend and they're just doing it to do it? Or Like what's making you different in that kind of case where it seems like you're going to have that over the hump marketing moment?
Well, as we grow, we expect marketing costs to their customer acquisition cost is going to go up. However, initially, I think it's bad. I put it up to it. We're a lot more resourceful than most founders, if we're being frank. When it comes to, we're taking a similar approach when it comes to podcasts and YouTube channels. You should see the list we're putting together for those. So I give a lot of credit to our resourcefulness. Granted, I mean, we're looking at our customer acquisition costs. We know, it's anywhere between $4 to $7 a user currently. But I chalk it up to our resourcefulness, to be frank with you. We're not looking to spend a lot of money on advertising because we would rather spend that on our product, and we know that the legal back end is gonna need it as well too. I
suspect as well that a lot of people heard in the news about Robinhood. They had to raise a couple $1 billion after GameStop. And that was really just to cover all the margin calls that sprung about it. So I mean, that was out of necessity more so than a marketing standpoint. So I would think that since you don't have to worry about shorting and that kind of thing, that you don't have to worry about raising that kind of money to offset those expenditures.
And to be frank with you, we don't like their business model too either, Stan. Just not to cut you off, but I just wanted to say we were kind of talking about their business model. I know like 2 days ago. We don't necessarily like that. How they get paid for volume. It's kind of shaky.
Yeah, and I think that's just how it is across the board. I think that whole financial market is it's so antiquated. It's really scary when you see that a Robinhood getting so much crap for what happened. It was like, well, they're just the first company to experience that type of transactional volume. The market has always been that fragile. We just hadn't stress tested it to that point.
No, I will say, kind of going back to Zach's question on the marketing. If you look at, we did a lot of research into Robinhood's kind of early stage marketing strategies. It took a lot of stuff out of their playbook. And if you notice, they're just really starting to do commercials the traditional way of advertising. Most of their advertisement was done, through referral, word of mouth, and, just people generally finding them in the App Store looking for a trading platform. Their SEO for their website and application was phenomenal.
Yeah, I definitely think you got to play the long game. And Zach and I were just talking yesterday about an experience that he had with a company that he was going back and forth with, and the whole, and it's really a transition now from a guerrilla marketing to a growth marketing standpoint, where everything is becoming much, much more personalized and really focusing on the customer, focusing on the product, and then you have a customer for life, and it's a whole lot cheaper to keep a customer than it is to acquire a new customer. So it's a lot of it's playing the long game, and it seems like you guys are doing that as well.
Exactly. And to piggyback off of that, part of that is just making sure that when we do get those customers, that's precisely why we don't want to spend so much on marketing. It's making sure that we develop a great product. And it's making sure that when people come to our platform that they have a good experience, that they're using their platform and it's not buggy, that it's aesthetically pleasing, it's simple, it's straightforward. So yeah, you're exactly right there.
What's the biggest thing that you guys learned along the way so far? Being not a ton of time into this, this is your third go around in terms of business. What's the biggest thing that you learned that you thought that you're surprised to learn that you may have thought that you already knew?
I will say the power of networking. Chris and I have always, talked to people, but I will say this is probably the very first time that, we, I guess for lack of a better word, network crawl through, the people that we know, who do they know? And, really just, we also learned, putting ourselves out there is like the worst somebody's going to say is no. If I need to find somebody who does marketing, I'm going to ask you, hey, somebody who does marketing, can you put us in contact? So we kind of learned that, straightforward approach and just ask the questions. You might get a no, you might get a yes. Doesn't matter if they say no, move on. So really putting ourselves out there, not being afraid to try to solve an issue head on, or try to solve an issue before it becomes an issue. And that's one thing that we've learned with this business, because there's so many moving parts, is that if you can predict an issue and, attack it and try to figure out at least a plan A and a plan B for it, or if it does go wrong, which it probably will.
It's just a matter of time until something happens that you're going to have to address.
Exactly. And, if you could figure that out, that definitely helps a lot. And that's one thing that we've learned from this particular venture.
Yep. And to piggyback off of what Stan was saying with moving parts, I would say, the power of delegation has been big with this one. With the other businesses, I mean, we've been able to do them with just, me and Stan. It's been, two pieces. With this one, we're having to bring in, we had to bring in a CMO, CFO. Now we're bringing in a chief acquisitions officer, CTO, and then, making sure that we have, structure and routines are incredibly, incredibly important. Making sure that we set out, tangible and attainable weekly, monthly goals. Problem searching, like what Stan was saying, staying ahead of the problems. Once we lay out all the stuff that we've got done or that we need to do for like the week or the month, okay, what else, do we need to get done? What else does our business need that, like I joke, but there's like, I have a list of maybe like 15, 20 things that we haven't necessarily discussed yet, but these are things that I'm sure that Stan also might have his own list, but these are things that we as founders, we know that the company has to get done, that we're trying to stay ahead of, that we haven't necessarily brought down to the team yet. But the power of delegation is something big that I think we definitely learned on this iteration.
So the company that Tim was saying did good marketing. I'll just give a quick little shout out of Boulder, Colorado. It's a electrolyte mix drink company called Scratch, SKRATCH. And basically I was just asking them a question about this product that they had. And it was on their live chat, which I'm sure went to a certain person. Right. But then at the very end, the person was like, hey, I'm going to paraphrase, but I'm going to send, what's your email? I'm going to send you this thing that will help you figure out exactly what to use. Cause basically I'm training for an Ironman, and there is some like hydration things that they wanted me to keep in mind. And so literally this company put together, like this chick, some of it's copy and paste, but a lot of it was custom. And it was like, gosh, like 10 pages worth of copy to help me out for $40 basically, which is ridiculous. Now, granted, I'm going to go back over and over again and buy this from this company, but like to think of it not as a transaction, but how long can we keep that person? And then what's the reciprocal effect? What's the viral effect of that thing? I mean, I think that's very, very powerful. And obviously I'm talking about here. I've given Tim a shot of it before. I don't know that he ever tried it, but like, it's something that I think is, what's a powder? Like I put a little powder. It's not like a shot.
In a Ziploc bag. What could go wrong, right?
Yeah, it was very hot. Hey, what's the thing you pulled over? That would be very good. Excuse me, what is that? Just taste it. It's lemon lime.
Not what it looks like, officer.
Yeah, I'm sure. Yeah, that would not be good. But I mean, I think that from a customer service perspective, I often go back to just, McDonald's and Chick-fil-A sell the exact same thing, right? A sandwich, fries, and a drink. One of them you love going to, and one of them you can't stand going to, right? And so the difference really is, now I know people will battle and say it's the food, but the difference really is customer service, right? You go to Chick-fil-A will have a line of 700 people in it, and people will be smiling, where McDonald's will have a line of 2 people in it, and people will be like, this is the worst experience ever. I mean, think about the stuff that you get through. Okay, so the market is super hot right now. It is May 13th, 2021, and the market is super hot. Do you guys envision that the product is good in any market, a hot market, a low market? Does it matter where the market is for the type of thing that you're doing? Where do you guys see that?
So I would say it does not matter which type of market that we are in, simply for the fact that the prices are low. So really what's driving this market is, somebody's buying a house. That's a big purchase. One person's only buying that. There's very little. There's demand, but it's not a wide open demand. By breaking properties down into fractional, they're more affordable. So we are anticipating more demand. So the way that we have everything set up, we do not see it being too, what's the word that I want to use? Too heavily affected by, the standard shifts of the real estate market. Well, standard shifts of the retail home market is what I will say.
And I'm thinking.
Go ahead, Chris.
And to be frank with you, just to kind of piggyback there, in a hot market, we were anticipating that, like, if we were to launch in a hot market and release properties in a hot market, we have thought about that, just because, I mean, from a sheer market standpoint, obviously there's going to be some issues. There's going to be depreciation in the short term. But we've thought about our jobs. We're looking at creating the best, essentially, stadium, and filling that stadium with great referees, so that way people can play the game. We're not necessarily there to prevent them from taking a loss. We're not there to help them make money. We're there to create the marketplace.
Who creates all the paperwork?
Could you elaborate?
So when you buy a house, there's a ton of paperwork.
Right.
Are you guys going to create all that? Are you going to send it out every year? Are a billion people going to be getting the same little, like, because also when you buy a house, your house gets the mortgage gets resold like a billion different times. Like, who's handling all of that? How is that going to look? Maybe it's a ridiculous question, but, like, there is, like, is part of what you guys going to do is handling that paperwork?
So we'll handle all the paperwork. So we'll distribute any tax information, tax documents. In our smart contract, there will be ownership rights. What you can do, what you can't do, that type of stuff. But as far as, we will handle all the back end paperwork. So our users will, have a simple platform. Just like if you went on to Robinhood and was like, hey, I need my tax documents, you would just download your tax documents. It's, we'll make it super simple for them and something that really anybody can do.
I was going to say, there's probably going to be additional. You are right, though, Zach. There is going to be additional paperwork that we're going to have to send out, just because, like the statements and stuff that I'll get from companies that I own shares in. We're probably going to send out something similar for monthly statements for each property, or quarterly statements for each property as well too. But probably not. I don't like the term paperwork, so we're probably going to try and email work. Maybe try and use some emails, because that is going to be quite a bit of paper. But yeah, they are going to be getting updates and information with the property information, with property information and tax updates.
And you guys, as we get ready to start to wrap on this, you guys have a hard stop. What's the reason for your hard stop?
Okay, so we're actually
what could possibly be more important than Zach and I and the Fervent 4 show?
They're dragging me away kicking and screaming, though. But we do have to go pitch a venture panel over at Kiwi Tech.
Well, how many people are going to be on that, so we can subtract it from 500?
They're anticipating anywhere between 20 to 30, so we can go on and just say 20 to lowball it.
Okay, so 480 to go.
Yeah. We had another little pitch for a couple 2-3 weeks ago for the William and Mary Alumni Angels. So we're starting to gain some traction as far as getting in front of people, getting really comfortable pitching. We've done a couple of pitch competitions.
The more you do it, the better you'll get at it. You'll learn.
Yeah.
Start rolling off. Yeah.
You guys advanced Start Peninsula, so you'll be pitching in the final round in November.
Exactly. We're excited.
So I'm sorry, Zach, how did you get invited to pitch at this event that's coming up in 10 minutes?
Well, so Kiwi Tech reached out to us very early on when we were in idea stage, probably mid-September. And we had kind of been going back and forth with them. They like our idea a lot. And they're kind of like there's a venture capital group called Sweat Equity who does they'll do, your website build and offer a bunch of different services. These guys are similar to that. So, you know, they're really, what's in it for them is they're trying to get us to work with them on their, you know, on the back end of our application, and do that type of stuff. So we ended up getting hooked up with them. And we've kind of been going back and forth for about like 4 or 5 months trying to, you know, hash out a deal with them. And then they were like, hey guys, we're hosting, it's called, this particular event is called Black Entrepreneurs Matter. So they were hosting an event to that, and they had just reached out to us. They said one of their groups had dropped out, one of the companies pitching, and they decided that, hey, we would like you guys to come pitch in their place. So, you know, once again, it's just talking to people, building those connections, and, you know, who knows what'll come. Like I said, we talked to them back in September. You know, who knows what'll come from a good interaction later on down the road.
You mentioned this a couple of times, and I think it's important to discuss it. Like, how do you, so Black entrepreneurship is something that is hot right now. It should always be hot. Is that something that, and I don't want to use the wrong words here, but is that something that you capitalize off of, leverage? Like, how do you incorporate Black entrepreneurship into the business to help you guys?
So it's really one of those things that we're capitalize on it as far as a, you know, like, we want to do it because we want other, you know, little Black kids to be like, hey, I can start a tech startup. You know, I don't need a rich dad to give me seed funding or pre-seed funding. I don't, you know, just because my family doesn't have money, you know, shouldn't keep you from trying. So that's kind of how we
doing. We're going to say doing. I got to cut you off there. We're going to say doing. Don't say trying. We say doing.
But yeah, I mean, so that's kind of how we look at it. As far, like, really, there's, you know, we put it out there for people to, once again, for people to see, but there's really, you know, they you know, there's some black stuff like that. But you said what?
Not to cut you off there, but I mean, to be frank with you, we haven't, I just have a bit to say on this one, but we haven't really tried to capitalize on it too much, just because, to be frank with you, it hasn't been a thing that's been popular until now. Like, it's not, so that, you know, it hasn't really been popular to be a Black-owned company until 2020, until 2021. So it's not something that we necessarily try to capitalize on. We're more focused on just doing the work. Granted, we understand the barriers and obstacles that come with being Black entrepreneurs. We're realistic about it. But at the end, we don't use it as an excuse. So that's why we're doing things like a WeFunder campaign, which is, you know, it's a campaign where we can control, how many people that we reach out to. We can control how many people we pitch on this campaign. The FTC can't tell us who can and can't, fund our WeFunder campaign, because non-accredited investors can invest in that. So those are kind of that's how we take the approach. I wouldn't say we necessarily try to capitalize on it, though, just because, I mean, statistically speaking, 2% of venture capital reaches Black entrepreneurs. So I mean, the statistics and the numbers still show that there's no real advantage.
I understand where Zach is saying, though, because I can kind of laugh to myself about this, because there's a lot of venture angels out there that, when they look at their portfolio and they see nothing but white male companies that they've invested in, you know, they're scrambling right now because they need some diversity on that portfolio. So it's not necessarily a capitalization on your part as much as a state of panic for investors. That they're like,
not even from the investor standpoint either. It's just, I think there's something that could be pushed. It seems like there are companies that are pushing, Black owned right now, and I don't know if that's helping or hurting them. I just see it, and that's more where my question was going.
I just like, I mean, Chris summed it up perfectly in the sense of hard work should be rewarded. I mean, I just can't wait till we get past all of this, where it's just reward hard work and people that are changing the world.
No, agreed.
Exactly.
How do you guys make money off of this?
So it's literally, essentially, to put it simply, we take a property that's worth $100,000. And because the demand for that property is so high amongst people that traditionally wouldn't have access to purchase that property, we're able to then tokenize that property on our platform for $200,000. worth of shares. So we take, you know, $100,000 property, we sell in our property for $200,000 worth of shares. So let's say, you know, there's 20,000, what is that? 20,000 $10 shares.
Yeah.
So that's yeah, me too. But that's how we, well, geometry, at least I wouldn't necessarily consider it's technically math, but yeah, that's how we make our money. And then we have a split. We have a percentage in that second 100%, which is.
So you get some of that, investors get some of that. Exactly.
So our growth strategy is actually completely organic. So that's why we're able, you know, we took some of the knowledge from our wholesaling background, and we're actually able to essentially, you know, talk to portfolio holders, say, hey, let's get your portfolio under contract. We'll give you, you know, 100% of market value. And then from there, we tokenize it on our platform for 200% of market value or 150% of market value or whatever makes sense to get our users a good return on that property.
Awesome. No, I love what you guys are doing. I mean, I appreciate the hustle. I wish that there were more companies like you. You know, I wish you continued success, and can't wait to have you guys back so you can tell us and share with us all the success that you're going to experience.
And please, please, please make him send every one of those 120 introductions. I want to see him get carpal tunnel from that.
It's bad because we're going to yeah. I was talking to Stan. I was like, if we only get a reply from like 8 of these people, we're gonna have to send another list to 10. It's like we're gonna have to send him another list. But yeah, no, thanks for having us, and you know, any opportunity we get to talk about Pocket Properties, we genuinely appreciate it, and yeah, you know, Tim, you've been such a help to us, you know, along the way as we've grown our company as well too, and Zach, we appreciate you for having us.
Thanks, guys.
It was fun. Best of luck getting to the 560 days, and like Tim said, keep us updated, and talk to you soon.
Awesome. Peace.
See you guys.